Hello, good morning, good afternoon, Khushamdeed. Ladies and gentlemen, please welcome Mr. JJ, the gorilla of stock market. And I have something very interesting to talk to you about. This is the story which takes place from the early 1990s to 2001. This was a wonderful time in history. The internet was going to change the world. But before emails and instant messaging, there was a breed of people who created companies and took them public. These people were consummate salesmen. They were true alchemists. But instead of turning lead into gold, they turned worthless paper into mountains of cash. These men and women were called stock promoters. I was a trader who was the man at the center of action where this process took place. This story will seem made up. I would think so too if I hadn't actually lived. So, ladies and gentlemen, I'm not talking about myself. I'm talking about JJ, whose most anticipated book is coming pretty soon. And this is the opening passage from that most anticipated book. JJ, welcome once again, and we would love to hear about you and your story. Please go on.
Thank you, Nalin. Nice to be here, and I'm very grateful for the opportunity to speak to your folks. I am, my background is I'm Sri Lankan. I was born in
Mhm.
Colombo, Sri Lanka. My parents brought me to Canada when I was two,
Okay.
back in 1970, and I grew up in a place called Saskatchewan, which is right in the middle of the province, right in the middle of the country.
Hmm.
The place is really cold, minus 55 Celsius in the winter. It makes
Wow.
Siberia look like the Bahamas.
Hmm.
And most of my friends were, rednecks, cowboys, people whose parents, used to have farms and things like that. And the city's only 200,000 people. So that's
Okay.
where I grew up. I played American football and, lifted weights, and I was a bouncer and went to university there and, did all that, the regular, normal Canadian boy stuff,
Hmm.
except not play hockey.
Okay.
But so I grew up there, and then after, my father passed away when I was very young, so I moved out to Vancouver.
Hmm.
And once I moved to Vancouver, I, I was a bouncer, and I was also working as an assistant to a biochemist, making soap. I also worked in a factory making office furniture. I ran the factory. I was a purchasing manager. I've
Okay.
done every single job growing up in Canada.
Hmm.
And so one night I was working as a bouncer. I was reading a book, and one of the traders from the Vancouver Stock Exchange came by, gave me a
Okay.
book called Liar's Poker by Michael
Hmm.
Lewis.
Right.
And I was hooked because I was trying to figure out what I wanted to be when I grew up, and
Hmm.
medicine was definitely not it. And
Okay.
so I read this book, I was hooked, and then from 92 to 95, 96, I tried to get in the industry. So what
Okay.
I did was Linda Ratchke in her book in Market Wizards with Jack Schwager said, get a job close to the exchange. I did that. I worked for the federal government because I speak
Hmm.
French,
Okay.
and started networking with people who had operations in my building. There was a little
Hmm.
East Indian man from Punjab, and his name
Okay.
was Barry Gill.
Hmm.
And Uncle Barry gave me my first job calling leads for his gold mining company.
Okay.
And, it was the first deal I ever worked on. This was 1994, 93. I would
Okay.
work all day at the government, go and call people at night, ask them if they wanted information on this company, got their address, sent it out. Then the next day, or, when they got that information, a closing salesman would call and get them to buy the stock,
Hmm.
right?
Okay.
So that's how the world works. And then he got me a job working for the company that distributed the leads, and that's where I got all my clients. So
Okay.
my clients, instead of going, I think you should buy Microsoft, buy 200 shares, maybe it goes up. That's how usual retail brokers work. I
Hmm.
was trained as a trader right from the get-go. My clients had millions, tens of hundreds of millions of shares of public
Okay.
companies. They invested in them, took them public. They were the investors. They're the smart money. And when that company goes public, they sell
Hmm.
that into the flow of retail. That's what a market is. Buy a bunch of cheap stuff, sell it at a higher price for profit.
Right.
So that's what I did. And so when I got my first trader job, I didn't know how to trade, but I had 200 clients who would deposit and sell stock at 3.5 to 5% commission. So that means
Oh,
if you
okay.
do a trade, if you do, yeah, because you guys pay, you guys whine about paying $1 commission on a trade.
Mm-hmm,
I
mm-hmm.
wouldn't, my ticket charge was $25. I wouldn't even pick up the phone for less than 3%.
Oh God.
So if the trade was $100,000 dollar value, my
Mm-hmm.
commission was $3,000 for
Oh
executing that
wow.
trade. Now, there's a reason why I got paid so much, not just to look
Mm-hmm.
pretty, because my clients, if they have supply, are shown first bid by the market makers. So my job is to develop good desk relationships with US market makers who get the
Okay.
order flow from E-Trade, Schwab, all those places. And so they would call me with an order. I would give them 3 cents for on that 100,000 shares. They make 3 grand. I make 3 grand. The client makes, his money because he got the stock for less than a penny. So,
Right.
to pay 6, 7,000 in commission to make sure he sells and
Mm-hmm.
captures that buyer,
Right.
that's worth gold.
Right.
So within 3 months, I was making 250 to $300,000 a month in commission.
Wow. Amazing.
Right. And that's how it, and my clients had owned brokerage firms. They were guys who ran funds. They were all different. Some of them were crazy. Some of them were very systematic and intelligent. So yeah, they taught me a lot about the business, and I still do business with those people
Right.
30 years later because it's all about longer term relationships.
This
And
business
so,
does have a lot variety of people actually, from very smart, very analytical, very systematic to very crazy.
oh,
It means you have worked with all.
I mean, the first time, I was trying to get into finance, I thought, oh God, I didn't go to Wharton, I don't have an MBA, I didn't go to
Mm-hmm.
Harvard. And the first time I went to the New York Stock Exchange, the traders were coming out to have a cigarette, and I started talking with some of them. And I was working in the industry, but I was working on the investor relations side
Mm-hmm.
to get
Mm-hmm.
these clients. And all of these guys were street hustlers from New Jersey, Staten Island, Long Island, with
Mm-hmm.
the thick, heavy accents. None of them had university degrees, but they were
Okay.
street smart, right?
Right.
They were street smart. They knew how to hustle. They knew how to build relationships. They knew how to collect favors. That's how the business is done.
Right.
Trading is a negotiation. And so if you're good at hustling, you're good at finding cheap product and then, selling it at a higher price. So that's what
Right.
trading's all about. And it was really great because, I did business with New Yorkers for my entire time on that side, and I still do.
Okay.
Yeah, so I spent most of my time in New York.
And what took you towards the retail education and retail trading, JJ?
Oh, in 2012, one of my best friend and my partner did crazy things. We were doing a deal, and he just started sucking money out of the companies and just going crazy with it. He was about 10 years younger.
Okay.
And started taking private planes and buying ski houses and they were doing crazy things like buying a brand new Mercedes and then spending $30,000 just to replace the wheels.
Oh God.
Buying 50, $100,000 watches, and I was like, oh, this is not going to end well, and it didn't. And
Okay.
so what happened was the stress of this whole situation, because there were millions of dollars at stake. My health got bad. I had a heart attack. I
Oh,
actually, and
okay.
I actually died, came back to life. I was dead for 4 minutes. When I
Mm-hmm.
came back to life, they said, you need a bypass, and I had a quintuple bypass at the age of 44.
Quintuple bypass
And,
at 44. Oh God.
yeah, yeah, we
Second
age
life
in
in a
dog
way,
years.
actually. Right.
Yeah, I'm probably on my fifth or sixth by now. So, when I was a bouncer, there was some crazy things too. Sometimes,
Hmm.
like I got the job because the guy before me got shot. So that's
Oh
how I
God.
got. That's how I became the head. You're head doorman now, right? And I slept with a gun next to my bed for a couple of weeks, just to make sure. So I've had a colorful life, and so
Hmm.
which really helps me in the market because you deal with all
Right.
kinds of crazy, from just ridiculous people, trying to raise money on crazy deals. And
Yeah.
Vancouver was a mining town, so there were 300 to 1,000 mining companies at any given time on the Vancouver Stock Exchange,
Okay.
and they had these flamboyant stock promoters, guys who
Mm-hmm.
wore all pink suits and drove, a pink Cadillac and had huge
Wow.
pinky diamond rings, that whole, like sleazy Vegas kind of thing, back in
Mm-hmm.
they were leftovers from the 70s and the 80s, but these guys were good salesmen, man. These guys could sell ice to an Eskimo, right?
Absolutely. Yeah.
So, and so, like one of my guys was, one day he was a bartender, the next day he bought a briefcase and a pair of cowboy boots, and he's a stock promoter, right? And 3 months later, he's driving a Rolls Royce down the street, So
Wow.
that's the way it was because, what you do is you go to a public company and you say, hey, listen, you've got a stock, it's trading at 30 cents, it trades by appointment only, maybe 10,000, 20,000 shares a day. I'll bring in
Mhm.
some volume. I'll get people to
Okay.
buy it. You give me a couple of million shares for free,
Okay.
right? So the first lesson in penny stocks is you never buy penny stock,
Mm-hmm.
right?
Okay.
Because they give it to you for free,
Okay.
right? So I've never bought stock in my life. The only time I've ever bought a stock is to cover a short, right?
Oh,
But I've never
okay.
actually bought and paid for stock because people ask me to work for them. They pay me a cash component every month and then they give me a million shares for free because it's
Okay.
just paper, right? You just
Right.
keep
Right.
printing it, right?
Right.
And that's what dilution is. So yeah,
Mm.
that's how I got into this crazy business. Wolf of Wall Street, when that place closed down, Belfort's firm, Stratton Oakmont, all of those
Mm-hmm.
guys became stock promoters. Some of them were my clients, but they all traded through Canada because
Okay.
Canada was offshore. So US
Okay.
people would put the stock in Switzerland, sell it from Switzerland into Canada through Vancouver into New York, right?
Okay.
So that was the path of the way money flowed back then.
Okay.
And
Okay.
so yeah, and we were right, we were like the gatekeepers to the US.
Okay.
And yeah, that's how I learned the business.
Very nice. And what led you to open the room and start the retail education, Ajay?
It became my notorious cheapness when I started trading, retail trading.
Mm-hmm.
I
Okay.
kept a trading log on Twitter,
Okay.
not thinking that anybody would ever look at it,
Mm-hmm.
right? All of a sudden, I had 100 followers.
Okay.
And I was like, oh, who the hell's following me, right? Because it was just a way for me not to pay for those electronic trading journals, right?
Mm-hmm. Mm-hmm.
So I just started posting stuff so I'd remember it and have a record of it. And
Okay.
then, my partner, Steve Dargenio from the room, he reached out to me and we started talking because he read my profile. And
Mm-hmm.
my old partner, one of my best friends, is
Mm-hmm.
from the same neighborhood in Long Island that Steve grew up in.
Okay.
So, and he was Italian American from Long Island. If you've ever seen the show Everybody Loves Raymond, right?
Mm-hmm.
It's these are the guys. I mean, and once these guys are your friends, you can trust them with your life, and I have.
Right. Yeah.
You know,
There is that sense
and
of
yeah,
camaraderie in that area actually.
yeah, and that's how we did business. And my old partner Paulie, may he rest in peace. COVID got him, but
Mm-hmm.
we did business. We were partners from 1995 until
Excellent.
3 years ago when COVID got him. And it was I was just blessed to have him in my life. He was the salesman, I was the trader. So he was a stockbroker. He'd bring in the buying, and I'd sell the stock
Oh,
from Canada into the
interesting.
buying, right?
Very
So
nice.
yeah, we were a good tag team. We had lots of fun and we laughed a
So,
lot, and it was a
so
great
how does
time.
your trade room function? So, what happens over there in the room? Like,
My whole philosophy in retail trading, because it's the most difficult job in finance, because you have
mm-hmm.
no resources, bad education, and no one to tell you that you're doing something stupid, right?
Right.
That's the problem, right?
Mm.
That's why 99% of retail traders fail because
Right.
the amount of misinformation on how markets work is staggering,
Right.
right?
Right.
So
Right.
what I decided to do is, and it's taken me years to figure out how to explain things to people in a simple manner, put
Mm-hmm.
together a process where they could look at, test, trade, manage trades, and manage risk. And it becomes systematic. So, like a fighter pilot, when something's going wrong in their plane, they pull the rejection cord, they do it
Mm-hmm.
without thinking, right?
Right.
So I teach
Right.
people how to take losses systematically without thinking and moving on to the process.
Very
using the
nice.
loss like a stop loss to ensure the account and also give you information about the market. The stop loss is a business expense,
It
right?
is. It
I'm the
is.
first person who's actually come out and said the stop loss is a business expense.
Right.
People always look at stops as being, they take it personally. They think they're a horrible person. They start rethinking every decision they made. When I was 16, I stole my mother's car. I should have never done that. And it's like, dear God, it's a business expense,
It is. Right.
pay the expense and move on. If you own a McDonald's and someone slips and falls in your restaurant, you have
Mhm.
insurance, but you have to
Right.
pay those
Right.
insurance premiums every month, right?
Absolutely.
It's just protecting your business. So I teach people how to look at the business. I teach people how it works, not
Hmm.
not the intricate little details, but so they have an
Absolutely.
idea that wholesale moves the markets when order flow hits it because they need to move their inventory. So we have a process. And I teach
Okay.
people how to learn how to make an income, right? Every day, make a little bit of money while you learn. When you're first learning, you're not going to make any money. So I teach people how not to lose money,
Hmm.
right? So
Right.
by the time you actually know what you're doing, you
Right.
actually have money to trade,
Right. Right.
right? Because most people will trade, blow up accounts, lose all this money, and then by the time they figure it out, they're out of money,
So the
right?
system which you have developed, it revolves around something what you call as the balance zones, right?
Exactly. And balance
Okay.
is what it is cost basis. A
Okay.
stock chart, a futures chart, any chart is a chart of the sales of
Okay.
inventory.
Okay.
Whether if
Okay.
it's over a day, a month, a week, or every 30 seconds, we want to see how the sales of inventory are progressing during the business day,
Okay.
right? And that's all a chart is. So I teach people how to read a chart, what the
Hmm.
chart actually really represents instead of all these crazy, cup and handle, teacup, flying pig, upside down baby, all of these crazy patterns that they're memorizing, but they don't
Right.
understand why the pattern has been created or the mechanics that are going on. And a lot of these trading educators say that trading it's all random and all of this stuff, which means they absolutely have no idea what's going on because
Sure. So
they've never had to buy or sell 5 million shares during the day. They've never worked a size order, so they have no idea that size moves the market.
absolutely. So let's look at the balance zones now, JJ. So I'll let you share your screen and then we'll move to
Sure.
balance zone, right? All right.
Sounds
So
good.
moving on to balance.
Great.
Okay. Okay.
Oh, okay. So we
Yeah.
found the right, absolutely right.
Yeah.
Okay.
Good thing.
So let's
Okay.
let's let's rewind a bit and
Sure.
say start with the basics of what is the ABC of your setup.
Sure. So the ABC of my setup is the balance, right? The balance occurs when you have a balance high and a balance low. The reason is the same people are buying and selling, right?
Mhm.
So you basically, it's like you're understanding the playground in which you're allowed to play in. Okay.
Okay.
Now, this is how markets work. When markets run out of sellers, they rotate
Mhm.
up to get to buyers. Now, a guy called Peter Stadelmeier, who came up with market profile, and Jim Dalton, came up with this when markets hit a balance low and look
Okay.
below it and come back up, the opposite end is the target. It is the
Uh,
simplest thing that nobody understands because they think trading has to be insanely complicated and they overcomplicate it. And but when I had a heart attack and that's why I had to learn how to be a retail trader. I thought it was going to
mhm.
be easy. It was very difficult until I found Jim Dalton because I didn't feel like memorizing 3,000 candle patterns and I had no idea what it meant. Dalton
Mhm.
showed us market profile. Things started to make sense, but unfortunately, he didn't go and tell us where to take the trade.
Yeah,
So I
absolutely.
spent years looking at how do we execute off this so people actually can have a simplistic way of
Right.
doing business and seeing when business suits them. This is the most
Right.
important thing there is, right?
Mhm.
Is when does business suit your conditions? Otherwise, this 90% of traders lose money because they're trading at the wrong time, right?
Mhm.
And
Mhm.
they have no idea, right? So what I've trained people to do, and I do this every day in my room and in my courses, is when the market looks below your balance level, right? what you do is when it reclaims it, okay, so this is the look below. The look below is here. Like, let's use this example here. This is a look below, okay?
Okay.
When the market, you don't execute here. You let the large traders execute here. Now, I've got a buddy called Harmel, and this is like when I go to dinner with him, he's a multimillionaire, he's a billionaire. When the check comes, I always let him reach for the check. Okay? So you let the millionaires and the billionaires figure this out,
Right.
right? You just sit and happily wait. When the market comes back over this level and it cannot take this level out, this is
Yeah.
where you build your long position.
So
Okay?
in a way, that is the reason it is said never catch a falling knife, wait for it to rebound.
Exactly.
Right.
Exactly. Right? Because you let some other guy go and take the risk. You know, in North America, you know, you always have this, they have this meme where this guy's like, I'm going to go jump off this, hold my beer. And you go, okay, I'll hold your beer. You jump off the bridge, my friend. Right? And if you live, maybe I'll jump. Right?
Yeah.
This is
Yeah.
in trading, you have to be shrewd because we don't have unlimited capital. We don't have, you know, people to teach us. We're sitting in a room, you know, when you're on a trade desk, and sometimes when I was starting out, you were on a trade desk and, you know, our head trader was a female and she'd see me calling in an order and she'd throw a phone and hit me in the head and say, hey, what are you doing? What are you doing? Stop. Right? We don't have that in retail trading,
Yeah.
right? We don't have checks and balances. You have to train yourself through process to be your own boss, to be your own compliance officer, to be your own credit manager, right? So the way you take this trade is you go long. Some people will wait till it reclaims here, right? Some people will execute right here when it first comes out. How you manage risk is you put your stop under this box,
Okay.
right? And you let the thing work and you put your target just a little bit under that line. So what I like to do, the way I trade is I trade 5 to 10 E-mini contracts in the S&P, and I like to make 3 to 4 points.
So
Do it.
1 point. So just to clarify for our viewers over here, a E
Yeah.
contract, 1 point is $1 movement, and $1
Is
movement has got
no
4 ticks.
one tick is $12.50.
Yeah. Sure. So 1 tick is 25 cents because
No, $12.50.
no, what I meant is, so if ES is
Oh, the quarter. Yeah,
47.78,
it goes in
yeah,
quarters. It's
right.
quarter, half, 3/4, and round number. Yeah. So each
So
point is
one
worth.
dollar of right, $1 is 1 point, and that 1 point movement gives you $50, right?
Yes. Yeah. So
Right. Okay.
yeah, $50 a point, right? So
Right.
if you make 3 points, that's $150, right?
Mhm.
And you do it with 8 to 10 E-mini contracts. There you go. You've done $1,000 a day. That's 20 grand a month
Right.
right? And you don't have to kill yourself to do it, right? You don't have to take every trade. When that trade presents itself, you're in, you're out, goodbye, right? Because people have lives. They can't sit in front of a screen for 18 hours a day. Of course, we have traders, you know, who trade prop professionally, you know, and that's all they do. But
Mhm.
90% of people don't have 18 hours a day, 12 hours a day to sit in front of a screen. They want to come in, they want to make some money. And here's the thing, the risk on this trade is always what we call structural. So what
Okay.
happens is if the market cannot take out the blow of that candle or that level that you see in red,
Mhm.
the
Mhm.
order flow is going in your direction. Okay.
Mhm.
Right. If
Right.
the market takes this level out, it means the order flow has broken the structure of the transactions of business.
Okay.
Right? Once that happens, the thesis for the trade no longer exists.
Okay.
Right? So this is very important because a lot of people have trouble getting out of bad trades. I
Right.
train people to systematically get out of bad trades. Sometimes even when you are more advanced and you learn the subtleties of it, you will start getting out of trades even before your stop gets triggered, because you will see the whole thing going wrong because you've experienced it 1,000 times over. So this particular trade, right, is scalable in time. I'm going to show you in the next example how you do this on a swing. Okay. As opposed to, this is a 5-minute time frame. Okay. So once you perfect trading on a fast time frame, the reason we want people to trade intraday for 3 to 5 minutes, quick trades, is number one, they can't hurt themselves because they can be stopped out. We have an instrument in North America called the micro, which is a tenth of the US, and it allows people to learn how to trade and maybe lose $20, $30, $50 a day. You can recover from that, right? So the main thing in trading is not to lose money until you know what you're doing. The main thing in trading is not to make money, because you have no idea how to, right? And when you have no idea how to make money, you completely, you know, you have trouble. So you will always start losing money when you're trading because you don't know what you're doing, right? It's a skill, it's a craft, and you have to learn how to, you know, you have to learn how to manage risk, right? When you first start working at a brokerage firm, you're not trading. You're getting the breakfast order. Okay. And if you can successfully manage ordering, getting the breakfast order right for all the traders, then maybe they'll give you an order. But if you mess up the breakfast order, guess what? You are not going to be ever trading. Okay. Because it's the firm's capital and any one idiot can take down a brokerage firm, right? So they don't allow us to trade right away. They teach us, right? And this is the thing with trading education. We always have people, who say, "Oh, you should be making money. You should be making money." But Nalin, can you raise your hand again in this thing so I can find you? Thank you. And the thing is to manage risk, to keep your money until you know what you're doing. And what we're going to do now is I'm going to show you how that's done. So as soon as you're inside the trade, right, on this small time frame, as soon as you're long, say you're long, the price is between 70 and 72, right? So you're long 43, 72, 73. Maybe you've bought 5 contracts. In the middle of this box, you put a few sell orders. This is called selling into strength. This is what we are trained to do. Okay? Because we cannot put all our money onto one trade, right? You want to turn your inventory into cash as quickly as possible, just like any business, right? Just like any business, you want to turn that inventory into cash. Trying to find you here. Sorry, Nolan, can you raise your hand again? I don't know why this thing's doing it. So you want to turn your inventory into cash. You're always selling. There's always going to be a next trade. Okay. And in a choppy market, you must take profits quickly. One second here. Sorry. So getting back to the example, Nolan, I'm gonna unmute you after I'm finished because this is a little disruptive. Okay, so the reason for this trade is that supply has run out underneath this level. The market will push higher to look for supply. Okay, when the market does so, right, I am a seller. Right? I am the supplier, right? I provide supply. I'm long at 70 to 72. I'm selling from 74 to 78. The reason I stagger my sell orders is to make sure that people are willing to buy my product. If they are not willing to buy my product, why should I be holding inventory? Does that make sense?
Right.
Right?
So
It's
in a way,
very
what you're
simple.
saying is the moment you enter, you put a stop loss.
Yeah.
Don't wait for your full target exit a part of it in strength and keep a little bit more till you keep trailing your stops, right?
Exactly. You can trail your stops. I always put my orders in ahead. So if I was long 5 contracts between 70 and 70 and 72, right? Say I have a 72 average on 5, I'll put one at 74 and a quarter just to see if there's a buyer over the middle of that range,
Mm-hmm.
right? If that gets taken, I'm out 1, right? Leaves 4.
Right.
Next order is at 75 or 74 and 3/4, right?
Right.
Out 2, leaves 3. Then next order is just underneath 76, 75 and 3/4, right? That gets taken. Out 3, leaves 2. Now, I always sell before the target.
Mm-hmm.
Okay. I always sell before the target because I don't like holding inventory. Inventory ties up capital,
Right.
right? What traders do is they get stuck in this trade and then they hope for this and then they get
Mm.
flushed out, right? This way, when you're learning how to trade, you want to learn how to trade quickly. Trading quickly is like, let's be honest, ladies and gentlemen, trading is like being in a street fight. Okay.
Mm-hmm.
You can't have too many things going through your head. You can't be thinking of Pythagorean theorem when you're getting kicked in the head. Okay. You have to be able to train yourself to react when things happen.
Right.
99% of traders, when they're in a down position, freeze.
Mm.
Okay.
Right.
They're not used to being punched. Mike Tyson says it. Everyone's got a plan until they get punched in the face.
Right. Right.
Okay. And that everything goes out the window. They panic, they freeze, they get mad, and there goes all your money. Right. If you systematically, what I do in my room and in my education courses is I teach people how to do the same trade over and over again 1,000 times. So it's like breathing, it's like brushing your teeth. You get out of bad trades like you're brushing a piece of lint off of your shirt, right?
Mm.
You don't have a big mental breakdown. You don't have to go and see a trading psychologist and sit on a couch and tell them about your childhood and all this nonsense. Retail traders have all these things that let us off the hook. FOMO, revenge trading, boredom trading. All of these things are excuses for unprofessional, unbusinesslike behavior,
So,
right?
Joseph, since you have been working with retail for a pretty long time, in your
Mhm.
experience, what sort of a learning trajectory should a people expect, especially if they're learning systematically? And what sort of a time horizon they should have in mind so they don't develop fancy ideas, especially because you see a lot of gurus promoting, 100% sure strategy or
Oh,
six
yeah,
week.
of course. I mean, and that's been around since, I mean, there was a guy in North America called Tom Wu in the 80s who used to teach people how to invest in real estate. And he'd put
Mhm.
himself on a yacht with a bunch of pretty girls. And, he'd say, look at me, I've got all this money and I'm driving a
Yeah.
Rolls Royce. And people would pay thousands to go to his seminars, right?
Okay.
And so this has been around forever, right? And
Okay.
unfortunately, in trading, there's no policing of education, right? So,
Mhm. Mhm.
I used to be a waiter. Now I'm teaching people how to trade.
Right.
Right? Come on. All right. So, um, so it's very hard. And the people, people have good intentions. They're trying to make money. They're trying to look after their families, and they get taken advantage of. And there is no regulatory body that polices this to, say, hey, this guy doesn't know what he's doing, right?
Mhm. Mhm.
So that's very difficult. So it's very hard. Um, Anybody who's trying to sell you software, that's all nonsense. All you really need is a good candle chart to trade. You
Mhm.
don't need any of the stuff that they say that you need, right?
Okay.
I'm going to show you right now how our large traders. Now we have a friend of mine, a friend of the room. He just sold his prop firm for I think he sold it for like over $1 billion. He started
Wow.
out with nothing, and this is how he trades. Now, he trades in the thousands of e-mini contracts.
Okay.
Okay? And this is how the large fund guys trade. So what I have here, this is an example. I had a balance zone. This is from COVID, and these levels expanded are still working today. So 27.50 to 28.10 was my balance. You double it to 29.30 and then double it again to 31.71. The reason why this occurs is this is your cost basis. This is 2 times your money, and this is 4 times your money. Okay? Because that's business, right? So in this particular example, you see the market break above 31.71 here,
Okay.
right?
Yeah, right,
And then
right.
it comes back in. So what traders do, now it shows a gap because this doesn't have the overnight session, okay? But what traders will do, what this guy will do in that is when it comes under 31.71, and it'll do this and kind of accept, he will initiate a short position here. His out is above, what he'll do is so if he'll be short maybe 1,000 contracts, okay, between 31.41 and 31.71. He has institutional money. I mean, he trades with over $1 billion in cash, okay? So, and leveraged up, that's 3-to-1, 4-to-1 at a prime brokerage. So, he's trading, say, 1,000 contracts between 31.41 and 31.71. His danger level is 71. If it breaks that, he starts to manage his risk by cutting his position.
So
Okay.
this is opposite of look below and fail. This is look above and fail.
This is a look above, and this is a look above. So what happens is he will manage that position with size, right? If it gets over 31.71 and the market starts offering over that, he'll cut his position by half.
Okay.
All right. And then if it gets in to this area here, right, he will start to cover and cut his risk, right? Now, if the market stays underneath, what he'll do is say he's short 1,000 in this area. Say he has a 31.50 cost average on 800 to 1,000 contracts. At this level, when the market looks underneath 31.11, he'll take back 200. When the market goes under 30.50, which is half of this zone, he'll take back another 200. 29.91, take back another one. Now, the target is 29.30. Failure to break 29.30 immediately tells you no one in the entire world is willing to sell into that price, right? And you cover your last 200 here. Now, for long traders, this is an adaptation of the look below and fail. This is the fail to look below, where you would initiate your long between 29.30 and 91, and then sell a quarter here and another quarter here. Right. And then if it can't get to 31.71, get out. Right.
So
this is how these guys make 10, 20 million a month trading this thing.
So usually in such cases, you will see buying above the expected area of support. And usually you will have a wick over here demonstrating strong buying coming in that level, right?
Well, you don't even need to go that far, right? It's very simple. If a market cannot trade under a level you are looking at, no one is willing to sell. See, the problem that short sellers always get is short selling is a difficult proposition because sellers mask their intentions. Buyers do not, because they're short covering and they just come in, and because they have to cover 1,000, 2,000, 5,000 contracts, they cannot mask their intentions. They start competing, price goes up. That's why going long in a market, especially in US markets where we're in an asset gathering, revenue generation model for the US capital markets, nobody sells anything because we have lower interest rates and billionaires don't sell their stock. They just get loans against it. Right. So, what happens is markets will rotate, right? This concept of rotation is what smart money makes money on every day. And the concept of rotation is what kills people who don't understand how markets work. Okay. Because they'll be shorting here and they'll be going long here. Right. Because they don't understand the concept of rotation. Right. Every time I post something on Twitter, some knucklehead, God bless him, will say, oh, it's going to go to, it's going to, the markets are going to sell off and go. And, I tell them, listen, when you should get nervous about a real market sell-off is when you see 400 million shares of Apple and Microsoft go across the tape. Those
Right.
stocks trade a fraction of the available supply. Okay.
Right.
There's no way BlackRock, who owns almost 1 billion shares, and State Street, who owns more than 1 billion, they can't sell their stock. It only trades 60 to 100 million shares a day.
Right.
Right. It is if those two investors came out of Apple, Apple would be trading at a nickel.
Right. So
Right.
JJ, what you were saying about look below and fail and the balance,
Yeah.
if you don't mind, I have marked some levels on Indian chart. Is it okay
Sure,
to
sure.
share?
Oh
Right?
yeah, go ahead. Go ahead. Hang on. Let me stop my sharing and fire in the hole. Go ahead.
Okay. So let me just quickly share the screen I have. Uh, so this is the long-term chart for Nifty, which is quite similar to what we saw just now from ES.
Mhm.
These are the three main gaps. And this is the blue zone over here, which I marked as the balance zone.
Mhm.
One. Oh, sorry.
Yeah. You can use the annotation on Zoom if you
Means I will have to learn that. So let me quickly put the arrow line and see. Yeah,
want. No
see, this is
problem.
the original balance zone.
Yeah,
And if we see 4 times the balance, and this is how the market moved up 4 times, and
exactly.
then again it came to another balance zone over here.
Exactly.
And then again, what we see is 4 times it has moved over here. And these are the upper stops. So we will see for a reaction at this area actually.
Can you,
And let me now share the daily chart in a
sure.
minute. Um, uh, yeah.
And I usually provide levels for Nifty, but we had some Nifty traders in the room, but they stopped asking me to do the charts. So I'll start
I will
doing them
start to.
again. Yeah.
So now, if you see the chart, this is the chart
Yeah.
for yesterday.
Okay.
Which, yeah, this is the chart for yesterday for Bank Nifty.
Yep.
And this is the balance zone I marked in the morning. And if you can see, it went just exactly one balance zone down below.
Mhm.
And after that, its journey has been almost throughout twice the balance zone, and then again twice the balance zone,
Yeah.
and then again.
It's a beautiful chart. And let me see if I can actually what I'm going to do is I'm going to grab a screenshot of your chart and then I'm going to share it and I'll show you my
Okay.
um
Please stop. Or else should I share the screenshot on WhatsApp with you?
no, let me see. I've got it. I've got it.
Okay. Okay.
So
I'll stop sharing my screen.
sure.
Okay. And JJ, now we are opening the group for questions. So we will be aggregating the questions, and in 5 minutes we will start to take
Beautiful.
questions.
Beautiful. Now you folks can see my screen, right?
Yeah, we can see.
Okay. And it's got the right screenshot just to make sure, we don't mess this up. All right. So here's your balance zone, right? This is the acquisition of the products. There's the look below balance, the move back up. Then we come
Mhm.
back into balance, retain it, right? This is where the wholesalers are long. If you drew a volume profile, you'd see a good amount of volume in that area.
Right,
Okay.
right, right, right.
So now what we're going to do is we're going to take this and we're going to take the market sideways to get rid of it.
Mm-hmm.
Right. So once you go sideways to get rid of it, then all of a sudden this is what they call a stop run. You folks
Mm-hmm.
call this a false breakout. Okay.
Right,
What that is when these wholesalers take it sideways, a big buyer comes in, they lift price for just a little while and sell into it. You'll notice that it does not break this level,
right.
right? Then this price stability brings in buyers. What that means is people love to stand in line. When I ran a nightclub, I'd open the club at 9. At 10 o'clock, I would start a lineup. The club was empty. By 11, 12 o'clock, I had 300 people standing in line waiting to get in, right? People follow price. So all they have to do is they get a couple of decent buy orders, they lift prices, people come in, you get this move up, and then you get more distribution in this area. And now this whole area above, say, 47, I'm not sure what this level is right here. This is
47, 850.
850. This is beautiful distribution. Then you run out of buyers, you mark down the product, and because what happens is you sell to longs here, right? Initiating longs. They're looking for this. When that doesn't happen, they start to sell. So now they've got a cost basis between 47,850 and close to
900.
yeah. So their cost basis is here. Your cost basis is in here and here. So you sell the market down, you flush them out. Notice that it does not break this distribution cost basis, right? Then what happens is the shorts who shorted here, they'll come and bid the market here. Shorts are always the first to come in and buy when a market drops. Because what they're doing is they're closing a position. It's a risk-off trade, right? And if they have to cover size, 2, 3, 4, 5,000 contracts, they're in the door. They come in the door like Walmart shoppers on Black Friday, right? And they gobble up all the product. They hold price. The large traders just stop selling, right? Then the market bids up when the shorts run out of supply and realize that supplies run out. We move back up, another little distribution. Buying begets buying. You move it back up, distribute it. And then after this big, nice distribution, right, in that 4,800 level, mark down, but you see we still did not break that cost basis.
Actually, the best thing was, JJ, this was a single print zone, and the single print didn't break.
Didn't break. I'm just going off. So probably there's single prints if you look at a TPO in this area.
Yeah, over here, right.
That shows you that the shorts are trapped there, and they come in, and what it's called is shorts come and they bid to cover. They buy to cover. They buy to close. They're the first in the door. The large traders see that and they go, okay, we got them. Just stop selling, right? And it's like, when you take a string in front of a kitten and the kitten jumps and you just keep moving the string up. It's the same concept, right? And these people will chase and chase and chase. And that way, now here's the other thing too. On this liquidation where the market sold off from that high level, right? And came into your single prints, there's something very interesting that happens. There's a dynamic that most people aren't aware of, right? But it's been going on since the beginning of time. What happens is when the market comes down into this area, it doesn't stay there for long.
Right.
It's the concept of time. The reason is the smart money who's short under here has averaged into the move, right? To get their cost basis on this short up. So they'll come racing in to cover here, right? They soak up the supply quickly and then momentum initiating long jump in because they see that movement, right? So what happens too is the second dynamic that people don't realize is the smart money is covering here, the dumb money is shorting. Because they have no idea what cost basis is. They don't have any idea what this stuff is. So they're following price. And like I say, this is like following that pretty girl into a dark alley at night after the nightclub closes. You wake up the next morning in a bathtub full of ice, missing a kidney. Don't follow price, right? You observe it and you look to see where the shorts are going to cover, and you want to be initiating long here or closing your short here. There's only two trades, right? It looks great after the fact, right? It's obvious, but you have to learn the business actually creates the chart pattern. Now, retail traders have cup and handle, teapot and tea cozy, all these crazy patterns, and I don't know what any of them are. All I know is the market has found the bid at 47,750. There's a bid here because the shorts have come in to cover and supply has run out. And nobody in the entire world wants to sell under that level. So what
So,
happens
JJ, for
is,
the benefit of our viewers, if you can just re-explain this chart once more, going step by step, finding the balance, finding the look below and fail, accumulation, distribution, and how the
sure,
bids are coming, so that
sure,
it becomes easier for all our viewers to understand this part,
no
please.
problem. This blue area that you found a low and a high. And when you look below that high, that low, you come right back to that high, right? And then when you look above that high, you come right back to that low. This is the concept of balance, or the concept of two-sided trade. That is how positions are built.
Right.
Okay. Now, this is a beautiful opportunity to get into the trade when it looks below, fails, and comes back up. Smart money who have been, you let the large traders work this out. You come in when this happens and you put your offers into this. And when the
Hmm.
market blows through it, you use each of these levels as a target, right? Then what happens is supply shuts off here. Now, why does supply shut off? Because let's close your eyes and pretend you bought 5,000 contracts here, okay? And Nalin bought 5,000, I bought 5,000, my friend Ravi bought 5,000, my cousin Rajiv bought 5,000, and we're all selling happily to all the new people who are coming in. But the thing is, the shorts who are stuck here, who are holding the market up here, we know they're short. So every time the market comes down, we just stop selling.
Right.
Okay. Take it from me, because I've short squeezed stocks from 30 cents to $300 on NASDAQ and on penny stock markets. I once held a stock at $30 on NASDAQ National Market for 3 months. We held it at over 90 RSI for 3 months, because a certain financier who's well known was going to finance the company for 200 million in a credit line. His proviso was that the stock did not drop under $30. So they flew me to New York on a private jet to engineer a short squeeze. Short squeeze are engineered by lack of supply. It's simple. You don't need a lot of buying to move a market up if there's nothing for
Right.
sale, right?
This is one of
And
the question which thanks.
no problem.
So some of the questions which are coming in is that when you are looking at finding the balance zones, since Indian
Yes.
market work only for 6.5 hours,
Yes.
and in the US markets you have the Globex and
Yes.
others like 23 hours. So how much time should one take to find balance? Or
It,
should they pick up from the previous day, or like how long should they wait to find a balance zone?
you can pick up from the previous day. The
Okay.
other option to do is, what time frame are you trading? Right?
Okay.
It's always good to have larger daily and weekly balance zones so you know where you are. See, a chart is like a map of the city. So a weekly and a daily chart is the map of the entire city. Then you
Okay.
go into a certain area of the city, and maybe that's a half-hour chart. And then
Okay.
you go into a certain little neighborhood in that area, and that's a 5 or 15-minute chart, right? All
Okay.
these charts are nothing more than a record of the transactions, so we can keep track of how inventory is being sold. That's the only reason a chart exists, right?
If you can take a minute to explain what is inventory and what's the importance of inventory
Okay,
in,
great
in
question.
markets which are not running 24 hour, 24 by 7
It
actually.
doesn't matter when the market could run for maybe 4 hours a day, right?
Okay.
It's irrespective. Let's
Okay.
say, Nalin, that you are selling mangoes,
Mhm.
okay? You must acquire an inventory of mangoes,
Right. Right.
right? You will take those mangoes to market and try and sell them for a profit, no?
Right. 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 Right.
Right? The same
Okay.
concept applies in a market, whether it's Microsoft or Apple. There are wholesale market makers and large traders who act as market makers, who accumulate inventory and then distribute it for a profit.
So,
Okay.
like most of the members in our group are intraday traders, so they
Sure.
will scale up. There are few, of course, who look positionals, but most of the
Sure.
people they look at indexes. So, in terms of indexes, one of the reasons they go for indexes is because of liquidity and
Yes.
also usually indexes are not influenced by stock specific information.
Well, exactly.
So in terms of indexes, how should one look at finding the balance? Because the market is open only for 6.5 hours, JJ.
Now, you guys keep saying that, but that doesn't matter.
Okay.
Okay. What you need to do is, what's your time frame?
Okay.
Are you holding trades? Are you a day trader? Are you a scalper? Do you hold for 2 to 3 hours? Right? If you're not consistently profitable and you're not making money, you shouldn't be
Mhm.
trading more than a 5-10 minute time frame,
Okay.
because you don't
Okay.
have the skill to manage a trade over a longer period of time.
Okay.
That the time frame that you hold a trade for traders, and they don't know this, nobody tells them this, right?
Right.
That's why scalping is the best way to learn,
Mhm.
because you get out of trades in and out quickly. So you
Mhm.
train your reflexes. Because if you're in a trade for a long period of time, most probably you are going to go through a range of emotions, and the emotions are caused by a lack of understanding of what the hell's going on. It's really that simple,
Right.
right? I've been there myself. I'm not, when I first started retail trading, I couldn't trade my way out of a wet paper bag, and it was
Mhm.
really hard for my ego, right? So I had to learn all of this and break it down over the last 12 years, and then
Mhm.
try and educate people so they wouldn't pull their hair out when they're doing this, right? So the whole point is, if you aren't making your rent, your mortgage, paying your bills by trading, it means you're not consistently profitable. That's
Mhm.
okay. There's nothing wrong with that. What we need to do is get you profitable. The way to get you profitable is teach you to trade intelligently with the
Mhm.
flow of business. Learn to do that. It's like when you say, I wanted to be an F1 race car driver, right?
Mhm.
Everybody knows who Lewis Hamilton is, and say, I'm going to drive his car in the next Grand Prix. Have you ever
Mhm.
raced a car? No, but I saw a YouTube video,
Mhm. Right.
right?
Right.
You have to start somewhere. You have to start trading on small time frames with small little contracts, so you don't hurt yourself, just the way a race car driver learns how to race in a go-kart, and then they
Right.
work their way up, right? Depending on their skill level. You're building your skill level. So look at a 1 minute chart, right?
Okay.
Very simple 1 minute chart. Here you've got, I think, is this a 5 minute chart?
It's a
Let's say
1 minute chart, JJ. It's a
it's a
one
one
minute
minute.
chart.
This is
Yeah.
perfect, right? So
Right.
here you've got a little balance zone, right? And you double it, or you do what you did here, and you just learn and take those look below and fail trades, right?
Right.
That's all you do. And you first start out on the simulator so you get to know the software. Pilots use simulators. There's nothing wrong with traders using simulators, okay?
Mhm.
Then what you do is you learn. I'm not sure what the products are in India. Do you have a product like a micro that trading?
What we have is usually people they don't go for futures; they go for options actually. So
Okay.
what many people will do is they will go either ATM, which is at the money,
Mhm.
or they might go OTM, depending on what sort of a
Sure.
capital interest they are looking at.
Yeah.
But futures, very few people will do because of, first of all, the cost implication, and also about the sort of volatility which is there. And it might be difficult to manage the
Okay.
stops with the future,
Sure.
actually.
What
And plus,
what
future attracts a lot more charges as compared to options.
okay.
Like in and out of a future might cost them close to $15 actually.
Oh
One,
wow.
yeah, it's quite expensive. Trading a future is expensive in India actually.
Really? Huh.
Yeah.
Okay. So, I honestly would recommend Indian traders learning how to trade the S&P, because it's 78 cents round trip on a micro, and
Yeah.
$50 day trade margin, $50 American, which is, I understand there's a difference with, currency conversion, but still that's an
Yeah.
affordable way to learn without incurring huge costs,
Absolutely.
right?
So, JJ, while we are on the concept of balance, one of the questions what we are getting is that if you can just repeat what are the criterias for identifying what is a balance range,
Okay,
and also, and the follow-up is how would we know whether it is an accumulation zone or it's a distribution zone so that people
great.
can look at what type of
Sure.
a trade to do.
Okay, accumulation zones happen after a market sells off.
Okay.
All right. Distribution happens after accumulation,
Hmm.
right? That's really all it is. So,
Okay.
here right? I didn't see what happens to the left of this, but this is obvious accumulation and this is distribution, right?
Okay.
It's really obvious. And I will, anyone who's listening, you can always reach out to me on Twitter. I'm VWAP Trader One. I always answer messages. And I'll put on more webinars and things like that to teach people how to do this. I think that would be a good thing to do. All you're looking for is the establishment of cost basis. That's two-sided trade. Now, here's the
Right.
thing with this, okay? Obviously, when you first see this, it's not going to be completely easy. What you're doing is you're going to train your eye to see these levels. And once
Right.
you train your eye, it's like that game, when you play, we're driving in the car as kids and you're looking for a yellow Volkswagen Beetle, right? And then after a while, that's all you see, right? If you train your eye to look for balance over time, what I did was I looked at stocks and I'd try and find balance zones on stocks. And then I would do the balance zone, double it to the upside, double it to the downside, and see whether or not it worked. So you train yourself to see this. This is what I do. I do the same thing every day. I come in, I look at the larger chart, then I go to a 1-minute chart and I look for my balance zone. Once I find my balance zone, if you join us in the room, I do this every morning at 7:30 in the morning GMT for the London Open. I do a 1-minute balance zone and then I share it with my folks in the room, double it, and then we watch and we test it with a few micros. We do what we call test trading to see whether or not our brains are actually working and whether or not we're in the order flow or sometimes we're trading too early. You always have to tweak and run diagnostics on yourself, which means,
Sure.
You'll get into a trade too early. Sometimes you'll know it. You should just get out of it right away. We have a
Right.
process to see, test, trade, manage,
Right.
and then also manage risk, right?
So, members, first of all, please ask your questions in the chat group, the FTU chat group. Second thing is what JJ was mentioning about his class. It runs from 1 o'clock to 2 o'clock in the afternoon when the London opens. And it runs from 7:30 to 9:30 in the evening when the US market opens. So, coming through, there are a couple of more questions, and we are getting more questions. One question has been asked, JJ. It is that what sort of a risk reward should one be looking at? And
Ah,
is there a sort of yearly target one should keep in mind when they start to work on this?
okay. First of all, when you start to work on it, don't have a target on on much money to make. Okay.
Mhm.
Because you're not going to make any money, right?
Hmm.
You're going to learn. So
Right.
the biggest thing is how much money are you not going to lose?
Mhm.
Okay. Not how much you're going to make, right?
Okay.
Because until you know what you're doing, you're not going to make any. Let's just be
Mhm.
honest. Okay. That's
Okay.
just I hate lying to people, right? It's going to take some
Okay.
time, right?
Okay.
Risk reward, everything for me. So say for example, if this market did this and looked below this particular level and failed, like here, I would be buying this level and my stop would be under that candle low right there, the
Okay.
wick of that
Okay.
candle. Okay.
Okay.
My stops are what we call structural. They're not based on a dollar amount. They're based
Mhm.
on the structure of the transactions of the distribution or accumulation of inventory.
Okay.
Okay. This is a business reason for the stop. The stop does two things. It tells you whether or not you're in line with the market. It also tells you about the order flow. The third thing it does is it insures your account. Always trade with a stop. Okay.
So a follow-up question over here, JJ, because you seem to say that your stops are not based on the price, but based on the structure.
Mhm.
So the question is, do you mean to say price action doesn't work, or how should people interpret that? Structural loss versus a dollar?
Right. Well, here's the thing. You have to decide once you have your balance, right?
Mhm.
It gives you a good idea of your target. So say
Okay.
I buy a position in this blue balance zone and it breaks above, right? My target will be right here, double of that balance. Okay.
Okay.
So am I willing to risk this amount of money from here to here to make
Mhm.
at least half of this or double,
Okay.
right? It's just pure business. If you see a market, the other thing too that I train people to do is when not to trade. Sometimes markets will be ridiculously choppy and there'll be no trade to be had like this, right? These are
Okay.
areas where you just do not execute,
Okay.
right? Especially like that look below and fail, right? Or you can do a look below and fail of this. It's very difficult to take it in the middle. What you want to do is you want to trade at the edges of these zones. So here I go, I'll trade here and I'll trade here, right? So for a lot of this, you're not going to trade. But the good thing is you're not going to lose any money, right? Get used to sitting and watching markets, especially when they're choppy, because a lot of these markets are what I call a pickpocket market, where retail people come in, think that they trade, they go long, they get stopped out. They go short, they get stopped out. They go long, they get stopped out. We take all your money and then you leave frustrated because you don't know when to trade, right?
So usually some of the people over here, they are a bit confused in terms of identifying. How do you identify that the sellers or buyers are trapped?
Oh, very simple.
Okay.
Sellers get trapped when, short sellers get trapped when markets move higher,
Right.
right? After markets move higher and then trade sideways for a while, people will buy that. And then, so say you buy 1,000 shares of stock at $6, right? And it trades between 6 and 7 and you're still long, and it drops down to 450. Well, you're trapped long.
Right.
This is just common business sense that nobody ever teaches. That's why everyone, and it's so simple that everybody has trouble understanding it because they've been brainwashed into patterns and algorithms and order flow and price action and all of these marketing words that these people feed people to get them to buy products and educational products. And that's why we don't charge very much, right? Because we know it's going to take long time for someone to learn how to trade. So we keep the monthly cost down in our room, right? And that's that's the thing. And that way you have time to learn. The whole thing is this is going to take some time. The concepts that I talk about, I thought everybody knew, but unfortunately they don't teach this in school, right? I've worked with people who went to Wharton. Worked with people who went to Harvard, and they don't even know what the hell inventory is, right? They've taken this industry and they've made it so ridiculously overcomplicated that people forget that it's even a market. And the goal of a market is commerce. It is the buying and selling of goods, especially in large volumes, right? And markets, you have to remember it's a market. There are people who buy large amounts of quantity at cheap price, and when price goes up, they are the supply, and and that's how they make money. And when buyers run out, they put it on sale. It's the same thing, right? So when buyers run out, what happens is, for example, in this chart, every time the market sells off, right, here you have shorts that are trapped that push price up. Here you have longs that are trapped that help push price down. When markets go up, right, you have buyers competing. When markets go down, you have sellers competing. So what happens is, say, Nalin, you and I sell, and maybe 10 of the people who are listening to this call, we sell all of these contracts to the retail who came in, right? Retail, wholesale, whoever came in above this level. Now, what happens is one guy starts to sell because it's not doing this, right? So when one sells, right, we own it down here and here and here, okay? Because we're wholesalers. We will sell the market down. The people who have a cost basis here panic and they sell out hard. And what we do is they go to sell at 5, we sell at 4. They sell at 4, we sell at 3 because we own it under $1. Right? Our cost basis is the lowest one. So we can sell because we have economy of scale. That's why Walmart puts people out of business, right? Because they own their inventory at the lowest cost basis. Right?
So, JJ,
It's the same thing in
thanks. And how do you identify traps like what we said about the stop run, or what we say, like what you say stop run and we say it's a false breakout. Is there a way to identify traps? And second thing is, so the aggregation of some of these questions say that how much you should double to understand where is high or low of a balance. If you can just explain that bit.
What you do is, at the first is you do your balance and then you double it, right?
Double it. First double
Yeah.
it. Right.
Yeah. And then if price breaks out of the double, then you just double it again. Very simple,
Okay.
right? Because you're just looking for distribution at higher prices. You're
Okay.
looking, and then when the market starts to sell off, you want to see sellers engage in price competition, which causes lower price, right?
All right.
And how do you identify traps is you sit and look at a market for a year,
Okay. For a year. Yeah,
right?
absolutely.
You need to get that experience.
Hmm.
There is, that's why, and you should also have a process. My trade process does not involve trading breakouts. Breakouts
Okay.
have unpredictable order flow. Breakouts are for suckers.
Absolutely.
Okay. Right. I
So Jitendra, I
trade
have seen.
hang on
Sure,
a
sure.
second, hang on.
Yeah, yeah, please, please.
I trade the edges of balance,
Right.
right? Because I know that there's a buyer and a seller that is going to engage, and my stop loss is based on when they stop engaging.
Okay. Okay.
Very simple. On a breakout, I don't know who the hell's going to come through the door. So the order
Mhm.
flow is going to be completely unpredictable, right?
Right.
I might get lucky, I might not get lucky. I
Right.
always think the way US casinos think, why not be the house? Because
Mhm.
I always
Okay.
was the house.
Okay. Follow up on that, JJ. What sort of a softwares do you use, like Sierra versus
Okay.
ATAS versus something else?
For Nifty, last year I was using Go charting to do my levels, right?
Okay.
They're a great little company and good people who run it. They're a new company, and they're cheap. So
Mhm.
gocharting.com. For futures trading, I use Sierra Chart.
Okay.
Sierra Chart has been around since 1986. It's quite cheap, and
Okay.
it is the most stable software that you can find for TPO charts. And
Okay.
since 2012, I've never been able to crash it, except when I tried to run Bitcoin because the tick size was too much.
JJ, on the OPEX days, or like what we call in India expiry days, do you
Mm.
look at what is the gamma burst or something
No,
similar?
no, no. That's
No.
all. That's
Okay.
that's like, all looking at all of that stuff is trying to do differential equations when you're getting punched in the face.
Right.
It's just a waste of time. You need to be The reason why traders don't is, number one, they don't know what they're doing. Number two is they don't focus. Right?
Mhm.
I have an exercise that I do with all my students. Can you focus on one thing on a 1 minute candle chart for more than 90 seconds and not look at anything else?
Right.
Right? Build that
Mhm.
up to 5 minutes, 10 minutes. Don't look at your phone. Don't look at the VIX. Don't look at this. Don't look at a footprint. Don't look at order. Just, can you actually focus on one thing for
Mhm.
more
Mhm.
than 5 minutes? If you cannot, you need
Okay.
to learn how, because I have traded through 2 earthquakes, 3 building fires. Unless I fall dead at the phone, I will not leave the screen.
Mhm. Mhm.
Right. So focus is everything, especially when you're trading hundreds of millions of dollars of client positions out. You're paid to focus. You have to focus. Don't read the paper. When you're sitting there to trade, you should be relaxed, but you should be focused. And you should be able to focus on price action. Everything that I talk about, people who join my room, at first, they don't know what the hell I'm talking about. I sound like an
Mhm.
alien. And then
Right.
um, after 3 months, they're like, oh my God, I can see it. You know?
And the focus is applicable not only on what you see, but also on the instrument. So you always suggest to look at one instrument or
Oh yeah,
as
yeah,
well as, right?
yeah. If you're a new trader, or if you've been trading for 20 years and you're not making money, learn how to trade one thing well instead of trying to trade 3 things badly,
Mhm.
right?
Okay.
I only trade the S&P E-mini futures. I know that market like the back of my hand.
Mhm.
It's like having one wife or 3 wives, right?
Mhm.
You know when she's in a bad mood, you know when she's in a good mood. You
Right.
understand the flow of the market. When not to give her. Don't bug her now, because she's going to snap your head off, right?
Okay.
So you get to know one market intimately, right?
Okay.
And you listen when it talks instead of trying to interrupt,
So, JJ,
right?
there are some questions on how to interpret volume profile. I have shared with you on WhatsApp a market profile with volume profile. If you could use that to
Sure,
explain.
sure. All volume profile is doing is it's showing you distribution and accumulation, right?
Right.
So let me see if I can open up your chart here.
I have sent you on WhatsApp.
On WhatsApp. Stay
Yeah.
with me, right? Oh, here we
Or
go.
yeah,
Okay.
yeah.
So all volume is this right here is all accumulation volume, and this is distribution volume,
Right.
right? That's really all it is, right? Volume, it takes time. This is the letters, right?
Right.
It takes time to acquire this volume. So underneath 47,650, this is the acquisition. The market sold off. You have single prints to the downside, right?
Right.
And so there is supply here, right? This is the overhanging supply. These people are selling out, so it takes time to accumulate that.
Right.
Once you've got that accumulated, then buyers will come in, you raise price and sell to them.
Right. And the interesting thing is the single prints, they acted beautifully. Like if
Yeah.
you see in the L period, the quick sell off, but the again short covering made sure that the single prints were not cleared off actually that day.
Mhm. Okay, yeah. Sometimes it takes time to clean up a market.
Right. Right. Of course, JJ, we are quite up over the time, and thank you so much
Yes,
for taking
my
questions.
pleasure.
The last question from here is that the markets are all-time high in India, and how should we look at extending the balance zones to see what sort of a trades can one take?
Just keep doubling them. Once you
Okay.
find a balance zone and you test it and it works, just keep doubling it so you know that if a market breaks out of a balance, to not short it until it re-enters that balance,
Okay. Got it.
right? And that's very that's really important. Um, we'll and then if you have any questions, just reach out to me. I'm always available.
Sure.
And I've got to do a little plug for my room, and I'll give you guys a discount code if you email me. So,
Sure.
or mail me. Nalin has it, and if you want to share that, that's great. Not pushing the
Sure.
room or anything, but if you folks are interested,
In fact, some of the
and
people have asked how can they join the room. So if there are
sure,
any specific queries, they can reach out to you, or we can help expedite, means we can help
yeah,
aggregate the whole thing via the moderators
yeah.
of this
And this is
room.
the room. It's microefutures.com. And I am VWAP Trader One on Twitter. Let me just open that up here. Where am I? Where am I?
And in
Okay.
fact, JJ's podcasts are beautiful. Like there are 121 podcasts by now, and
Yeah,
they have the very best people coming in, like Anna Cooling. And just now, of course, we are out of time now, but otherwise, I would have asked JJ to take his quick view on the BTC getting ETF. If we can take now, fine. Otherwise, we
sure,
can.
sure. I think it's a wonderful thing. I think I think we're it's a brave new world now. We have BlackRock and the large money manager firms in the markets. There's our YouTube page. It's Confessions of a Market Maker. We're proud we had Hunter Horsley of Bitwise on the day of approval.
Right.
He was our last podcast, and then you can see we've got the Bat Tony Batista there from Tasty
Yeah.
Trading.
That's
Great
one
guy.
of the funniest
Yeah.
podcasts I've ever heard, actually.
Yeah,
Yeah.
we have, and if you need anything, just DM me at VWAP Trader One, right?
Hmm.
And that's my Twitter, and I answer all DMs when I can. And if you need help or reach out, especially if you're struggling and you're having a hard time, reach out. We'll see if we can get you sorted.
All right. Thanks a lot, JJ. Sincere appreciation from the entire group. We had more than 500 people joining via Telegram Live and Zoom combined. YouTube link, because of certain reason, didn't work, but I think we had a fantastic session. Thank you so much for going almost double the time what we had signed up for. And also
Thank you.
thanks a lot for extending invitation to your room. We look forward to learning more from you. Thanks a lot, JJ. Have a
Thank you.
great day ahead.
Thank you so much. I really appreciate it.
Okay, guys, thanks a lot. Have a good day ahead. Thanks for all your beautiful questions, and uh, bye for now then.